have played a part in terms of boosting liquidity and credit conditions. Growth has maintained its overall growth rate throughout the 4 quarters. And as we showed, in Q4 in particular, private final consumption expenditure did quite well, and so did, in fact, the big improvement was in the case of capital formation in the 4th quarter. These are also, once again, as a percentage of current prices rather than constant GDP. We also want to show you, in general, there is a perception that India's growth rate has slowed down after the first 3 years post-COVID, FY 22-24 and FY 25 6.5%. I think it's important to understand that globally it is a growth scarce environment. Some of you may recall that in the annual World Economic Outlook, semi-annual World Economic Outlook, that the IMF, International Monetary Fund, brings out April-October. The April edition came out badly a month ago, and global growth numbers have been revised lower for current calendar year 2025 and 2026. Now, if you look at India's growth differential in real terms, what we show here is that real GDP growth of India, the blue colored bar, real GDP growth of what IMF calls about 30-odd advanced economies, and the difference is the green line that is charted. So now the interesting thing is India's growth in comparison to the average growth rate of advanced economies was on the lower side in the boom era between 2003 and 2010, despite one COVID year in which Indian economy did quite well, even compared to, not the COVID year, the global financial crisis year. Even then, the Indian economy did much better than advanced economies. And in 2009, advanced economies suffered a contraction. India's 2009-10 growth rate was actually on the higher side. But the point is, the growth differential in this period, post-COVID, the black line shows you, is higher than the growth differential in the boom era period. In other words, India's performance in a relatively growth scarce environment post-COVID, and in spite of the rising uncertainties due to geopolitical conflicts and trade tensions which predate 2025, I think India is actually holding up its growth numbers better than many advanced economies as well. I think that is something that we need to internalize quite a bit. That is why we put this chart together, to show you that it is not the absolute growth numbers alone that matter, but how growth is holding up in an overall growth scarce environment is equally important. In the economy itself, as we now move into 25-26, how are things holding up? Because we are now 2 months into the new financial year. Actually, what is interesting to note is that both manufacturing and services, the purchasing managers indices on your top left, they are firmly in the expansionary zone. Then you look at the e-way bill generation, picked up year-on-year growth rate, actually improved to 23.4% compared to 20.2% in the previous month. And then on the bottom, you look at the average hotel occupancy rate in April was slightly better than March 2025. And then if you look at the port cargo activity, again was much better than what it was in April 2024 and in April 2022. And growth in air cargo is 11.5% compared to 10% 1 year ago. So, or even for that matter, minus 4.5% in April 2023. So clearly, the momentum of the economy, which picked up in the 4th quarter, is continuing into the 1st quarter, and that's a good sign. Also, steady urban and rural demand. We covered many of this in the monthly economic review, but we just wanted to use this opportunity to share with all of you. If you look at the fast-moving consumer goods, in the 4th quarter in FY 25, rural consumption was high single digits, urban consumption was slightly on the lower side, and domestic air passenger traffic in FY 25 was consistently across all months above the previous 2 financial years. And vehicle sales overall, 3-wheelers, passenger vehicles and 2-wheelers have been maintaining their steady upward momentum. We are giving you the year-on-year growth numbers for April 2025 in the small box tucked in between the two charts. And the tractor sales performance in FY25 was 9.4 lakh tractors sold, as high as almost as high as 9.5 of FY23 and better than 8.7 of we all know very well that the headline inflation rate is converging towards the target, and the food inflation has eased. And it is a good news that the Met Department has predicted both spatially and temporally well-distributed monsoon in the course of the next few months, and that also augurs well. So I think the conditions are in place for a low inflation, steady growth environment supported by monetary policy and also the fiscal stability, which is resulting in a very, very record tightening of India's 10-year bond yield vis-a-vis the American 10-year Treasury note yield as well. And in terms of the external sector, core merchandise exports, what we call core is basically non-petroleum, non-gems and jewelry exports. Core merchandise exports was $344.3 billion compared to $320.2 for a growth rate of 7.5% compared to the growth rate of 0.1% in FY23 and 1.4% in FY24. So there was a pickup in the core merchandise goods export growth. And if you look at the performance in April 25, it is definitely doing much better than the previous two Aprils. In terms of services sector activity, the balance of services trade, the surplus of $189 billion, higher than 143.3, 162.8 surplus in the previous two financial years. These are FY24 is a provisional number. And the services trade per se in FY26, the first month of April, you can see that on the small box in the bottom middle, it is $35.3 billion of exports compared to the previous two Aprils, much better. And so is the case with exports, but with imports. But therefore, the gap still is close to about $17.8 billion, which is much bigger than the surplus earned in the previous two Aprils. And forex reserves are at their all-time highs. In terms of the months of import cover, it is very comfortable at 11 months. Gross FDI flows have been extremely very high, signaling continued interest in the Indian economy. The net FDI numbers are on the lower side, of course. We all know that, partly because of record repatriations and also partly because of record overseas direct investment by India. But thanks to services sector surpluses and remittances, etc., overall current account has been extremely well funded. And FPIs, while they may have been relatively willing to take profits from the Indian equity markets in the course of 24-25, they have come back in the last few weeks to the Indian market, given the overall macroeconomic stability that India offers. So the external environment poses no funding risk, but at the same time, we do have to increase our efforts with respect to attracting FDI in terms of global supply chain, China plus one, etc., as the global trends give us new opportunities and openings here. The central bank's monetary policy, the cash reserve ratio and the policy cuts are expected to aid liquidity conditions and credit growth. We can see that liquidity conditions have improved on the back of the RBI operations. And overall credit growth is at 9.9%, which is above the nominal GDP growth of 9.8%. And if you look at specifically in terms of capital formation and how downstream finished goods production is supported, you can see that capital goods imports have been steadily rising, and the share of capital goods imports is somewhere around between 20 and 25%. And if you look at the overall domestic production of capital goods in terms of index and infrastructure goods, they have been steadily rising as well. Basically, for the level of economic activity, given overall uncertainties, the infrastructure goods and capital goods production and imports are well supportive of the growth expectations in FY 25-26. The Ministry of Statistics has also come out with the first time survey of capital expenditure intentions on the part of the private sector. It's the first survey, and they did point out that there is some bit of reluctance on the part of the survey participants to share their capital expenditure plans with the public authorities, and that probably signals why FY26 numbers have been on the lower side. But what is interesting is that the FY25 numbers were a big improvement over what was happening in FY24, and that showed up in the GDP numbers when we saw that there was a big increase in the share of overall gross fixed capital formation as a percentage of GDP in FY25, which we saw in an earlier slide. So there is a consistency in the data, but at the same time, we don't need to overread into the number given for FY26, as the footnotes by Ministry of Statistics itself clearly cautions us because of the reluctance to share full details on capital formation. And the intent on the capex side, broken down in terms of sectors: manufacturing, information and communication, transport, and others. So it's interesting to see manufacturing occupy a very good share of the overall capex spending intentions in the coming financial year, in the current financial year. In terms of the private sector data on quarterly announcements of new projects in March 2025, 14.4 trillion rupees or 14.4 lakh crores, and capacity utilization has been steadily rising, which augurs well for capital formation not to disappoint in the course of FY 25-26. In terms of labor market, again, Ministry of Statistics is now beginning to publish monthly All India numbers. Urban unemployment rate has been coming down, and the labor force participation rate is on the high side. And in terms of monthly data, we are seeing in April 2025, labor force participation rate is 55.6%, and the worker population ratio is 52.8%, and unemployment rate is steady at 5.1% on all India basis. And net payroll additions in FY25 were close to 130 lakhs or 1.3 crores. Overall, new members growth has been steady in the last 4 years, close to around 80 to 90 lakh of people, but the net payroll addition is been more than 1 crore every year. Overall outlook for the economy in general, I think in the circumstances, which is why we have been sharing with you comparative growth performance of other countries and also comparing the growth differential with advanced economies, both in the boom era in the first decade and now. Indian growth performance has to be seen in that context. This is globally, because of uncertainties, growth is expected to slow. India has faced, therefore, similar forecast cuts from global forecasters, but at 6.5 to 6.3 to 6.8%, which is what we have in our estimate, it is still a very good growth performance in the current context of geopolitical and geo-economic uncertainties. High frequency indicators, we spent some time with you sharing how the trends look for the current financial year. The start is quite good, and the monsoon forecast is good. Monetary policy is growth friendly. Inflation numbers are supportive of a growth-friendly monetary policy stance, and all of them together augur well. Or in fact, just before I came into this call, I was reading the weekly Greed and Fear by Mr. Christopher Wood, a long-standing India bull, and looking at the spread between Indian 10-year and US 10-year Treasury, he writes that to predict that one day the Indian 10-year G-Sec yield might be lower than the US 10-year T-note yield is not too far out, because the spread used to be as high as 600 basis points, but the spread has come down to around 170 basis points these days. So that was quite interesting, and that is partly because of the exceptional commitment and adherence and also accomplishment with respect to fiscal policy goals. Now, it obviously helps the entire economy, the fiscal prudence, because of lower cost of capital. When the benchmark cost of borrowing by the government drops to 6.2%, interest rates across the spectrum in the private sector will also be capped. In that sense, it will also come down. So I think the fiscal policy stance has actually been stimulative for the economy through its impact on the cost of capital. We spoke about inflation being benign, monsoon expected to be good, etc. Export performance, again, within the context of uncertain global trade, we have done very well. Merchandise trade growth has picked up last year, and so did service sector surplus, continuing into the month of April as well. And the decline in crude oil price from around $80 per barrel to the 60s, and we all expect OPEC to announce another production increase in July as well. And considering that, I think clearly the upside to crude oil prices seem to be capped, and that is a good news for India as well, from both from a fiscal perspective and from a consumption perspective. Central bank rate policies are going to diverge globally, because some countries are looking at stagflation risks, whereas India is looking at this moment, in the context of where the world is, a fairly benign growth inflation environment. So we retain our growth outlook as something between 6.3 and 6.8%. Private consumption, especially the rural rebound and resilient services sector exports and steady capital formation as key growth drivers. Of course, international agencies are adjusting their growth numbers depending on global developments and domestic developments, and those the range is very similar to the kind of range that we have. So all in all, I would say, given the global environment, our economy is doing quite well, and if we continue with the efforts to bring in more foreign direct investment, and the private sector, if it continues its increase in capital investment, which we saw in 24-25, and urban consumption picks up on the back of, let's say, better capital formation, hiring, and compensation, then we can probably achieve a growth rate which is at the higher end of this range. If not, we will be closer to the lower end of the range of 6.3 to 6.8 that we have. Global risk factors would naturally be, of course, how the global financial markets behave, because in the last several weeks, from the middle of April until now, global financial markets have recovered, and so have Indian financial markets, and global bond yield also have come down. So overall, if there is renewed financial market volatility, etc., bringing additional layers of uncertainty, that will naturally cast a shadow. These are the risk factors we are tracking. You are reading about them in the monthly economic review as well, and we will keep you updated on that. With that, I end my presentation. As I said, we have a representative from MoSPI on this call. He will be happy to answer any technical question that you may have. Now the floor is yours. I request my colleague, Ms. Dr. Nanu Basheen, to moderate the Q&A session. Thank you very much.
Thank you, sir, for your meaningful and useful insights. So we now start with the question and answer session. First, I would like to ask Tarun Sharma from Z Business to ask his question.
Thank you, ma'am. Good evening, sir. Sir, I have two questions. One is on the urban consumption, sir. Do you think we have seen some slowdown in the urban consumption in Q4? Do you think after the income tax cut, we can expect some kind of pickup in the urban demand? And second, sir, in this last quarter, there is Kumbh Mela in Uttar Pradesh. Is there any impact on the GDP side also because of this Kumbh Mela, sir? Thank you.
So I think, based on what I could hear from your questions, I think first question is whether the big income tax relief provided in the budget will have an impact on consumption, particularly in urban India. My answer is yes. I expect that to provide a certain level of upside to consumption spending. Now, whether we can see a specific event in a specific state attributing it, it can be anticipated that it had a contribution, but to come up with an estimate, it is still early days to be able to say precisely it contributed X number, and we may not be able to do so in a precise form.
Sapna from CNBC-18. Okay, Tarun, please go ahead.
On second question, sir, on the Kumbh Mela effect on the GDP numbers because of the hotels bookings are on high,
Yeah,
as well as
I
the
think
aviation part.
I answered that question.
Yes, I think sir answered that question, Tarun. Next is Sapna from CNBC-TV18.
Hi, ma'am. Hi, sir. I hope I'm audible.
Yeah.
Yeah.
Yeah, okay, great. Thank you. So just one or two quick ones. We are still at probably a 3-year low in terms of the annual GDP numbers, the real GDP. If you could, give a perspective on that. Though, of course, you have explained everything that given the geopolitical uncertainty and growth scarce environment externally, that's one aspect. And sir, also in terms of the manufacturing, the share in the GDP, that's like kind of stagnant if not going down. Please correct me if I'm wrong. And also private capex. So you are indicating that it's more or less stable around 30-odd%. But if you look at it in a larger time horizon, it's been coming down steadily. So anything on that, sir? Thank you.
I think you are talking about cyclical and structural, you're conflating structural developments with cyclical factors. Here we are trying to analyze the GDP performance of FY 24-25 and the last quarter. Manufacturing share of GDP, if you look at even countries in ASEAN, every part of the world is having its own set of challenges in maintaining the manufacturing share of GDP, given the fact that one single country has set out to dominate manufacturing in a big way. So every country is trying to find its way to grow its manufacturing, and that is something that India has been doing with the tax incentives for new manufacturing enterprises, production-linked incentive schemes, Make in India, Gati Shakti, Atmanirbhar Bharat, multiple schemes, and also incentives given to new enterprises in manufacturing, etc. So, and improvements in physical infrastructure. All these things work naturally in the medium term due to the rising share of manufacturing. You also had a second question about what?
Private capex.
Yeah, so overall, by 29.9% is the national level gross fixed capital formation. It is not the private sector capital formation alone. We spent some time on the private sector analyzing the survey intentions of the private sector, and there we showed that private sector capex for 24-25 had shown a big pickup compared to 23-24, and so in general, if you look at the last 3 years post-COVID. Because we have data, granular data until 23-24 from Ministry of Statistics. The annual average growth at current prices of private sector non-financial corporations capex growth was 15+%, whereas public sector, government, and households and unincorporated enterprises, their annual CAGR growth of capital formation was over 20%. So it's not too different drastically. Percentage gap, these numbers yourself. There is a gap of about 5 percentage points. And then if you go and calculate average annual growth rate pre-COVID from 2017-18 to 23-24, annual growth in private sector, non-financial corporate sector capital formation was about 9%, whereas the other sectors like households, governments, and public sector enterprises, they were at about 12%. If you do a 6-year comparison predating COVID, or if you compare between 21 and 24 over a 3-year period, that growth rate is about between 15 and 20, and the comparison, if you take a 6-year view, is between 9% and 12%. So it is not as if the Indian private sector capex has not been growing, except that the growth rates on the slower side. But if I have mentioned this several times in the past, if we are expecting the kind of growth rate that we had in the first decade in the boom era, that is something that is difficult to anticipate because that is a global boom era. I just now mentioned that the global growth forecasts are being revised lower by the IMF, etc. Yes, Given that India has a large domestic economy, the private sector can definitely invest more, but how much it will ramp up in this current environment is difficult to say. But we are a structurally domestic demand driven economy, and there is scope to make it a virtuous endogenous cycle, as I mentioned in a different context yesterday as well. And that is something we are hoping that the private sector would do in the coming years.
Yeah, I have a request to make. So after each journalist has asked the question, please switch off your mic because it disturbs while CA sir is addressing. After asking the question, please switch off your mic. Now next is Kriti from Informers Media.
Hi, good evening, sir. So Q4 data, the GDP growth has been high. It's 7.4 primarily on account of strong net taxes growth. So, do you expect such strong net tax to continue playing such kind of a role going ahead in FY26 as well? And sir, I have a second question. I can see nominal GDP has grown to 330 trillion against the expectation of 324 trillion. Fiscal data is not yet out, so can I safely assume you ended the year at 4.7% with fiscal deficit of 4.7% of GDP?
I think the nominal GDP estimated earlier was 331 lakh crores in the second advance estimate. This is just a very slight difference in the provisional estimate compared to second advance estimate. So I think you may have to, it's a matter of few minutes before you can see the actual fiscal deficit numbers put out. There's no need to guess here. And as far as whether net taxes would play the same role in 25-26, we don't make any forecast for net taxes. I can't therefore answer your question.
Shishi from Hindu Business Line.
Sir, good evening, sir. Shishir here. Sir, I have the question since we all are talking about the above normal monsoon. But the problem is that the monsoon has arrived early and there is some unusual unusual rainfall in some parts of the country, which is affecting the vegetable prices also. Keeping this thing in mind, that how do you see that price trend, especially the vegetable or the food prices, sir?
Good question, but honestly, I don't think we should extrapolate a few weeks of prices and activity, therefore, to say there will be a problem. As of now, I think every indication is that farm produce will be good and that the benign food, there are adequate inventories and that the benign food price trends will continue.
Srini from NDTV Profit.
Hi, sir. Am I audible?
Yeah.
So with, rising global and policy uncertainties and recent judicial ruling, the outlook for exports and private capex, especially in export-driven sectors, seems subdued. So as countries like, China pushing ahead with trade deals, do you see clarity emerging for India post its first major trade agreement? And my second question is, sir, that with recent tax cuts likely to reflect in consumption trend next year, so is there any additional measure you think government should consider to further boost urban consumption? Thank you.
No, on the first question about trade agreements, you should be addressing your question to the Ministry of Commerce and Industry and not me. They are the best place to answer where we are. I think, and they have been putting out communication over in the media. So I think there is nothing new for me to add there. Now, whether we should be looking at additional stimulus, well, you just now mentioned that the government, that's the budget about barely 3 months ago, announced a significant tax relief. And under the current global context, the economy is doing quite well. Monetary policy has turned supportive, growth friendly in a benign inflation environment, as I mentioned during my remarks. So I don't see any need for, at this point in time, even to contemplate additional fiscal relief.
Alok from CNBC Awaz. Alok, are you there?
Yes, I am here.
Okay, please ask your question.
मेरा सवाल ये है कि जिस तरह से एग्रीकल्चर ग्रोथ के बारे में बात हो रही थी कि अच्छा हुआ है, जो करंट मॉनसून की सिचुएशन है, अर्ली मॉनसून भी है और उम्मीद की जा रही है कि मॉनसून आने वाले दिनों में काफी अच्छा रहेगा। एग्रीकल्चर ग्रोथ पे खास तौर से कितना इफेक्ट पड़ेगा आने वाले दिनों में, और जो करंट ईयर का ग्रोथ टारगेट है उसमें एग्रीकल्चर का ग्रोथ कितना उसमें कंट्रीब्यूट कर सकता है?
No, I don't think it's possible for us to give you such granular sectoral contribution to GDP growth at this stage.
Prashant from Financial Express.
Hello, sir. The RBI's extra dividend has created a fiscal space of around 60 to 70,000 crore in the current financial year. Do you think the additional resources should be, used by the government to increase the capex, or do you think it should be used to further reduce fiscal deficit?
I don't know. I don't have an answer to that question.
Meghna from Money Control.
So I just wanted to check with you because you have spoken on the share of manufacturing in GDP, but I wanted to understand from you the kind of manufacturing growth that we are seeing. Do you think that it is what kind of share in GDP we need to achieve the 2047 targets for manufacturing to grow, and what kind of momentum or push we actually need to make manufacturing grow to that level?
As I responded to Sapna, I think we are here discussing a cyclical annual growth number and a quarterly growth number. These are structural questions, and I answered her by saying that yes, we have been taking various steps and they will show results over time. One is the physical infrastructure improvement, several government-oriented schemes like PLI, Atmanirbhar Bharat, Make in India, and the tax incentive given to corporate sector, and recently many credit guarantee schemes for micro and small and medium enterprises, the increase in thresholds for small and medium enterprises, and then the various fund of funds that the government of India through multiple ministries is investing in, etc. So all these things over, and at the same time, the world also has been witnessing that manufacturing is a struggle and a challenge for many countries because one country dominates and other countries are trying to find their space in this deflationary environment because enterprises will be reluctant to put up capacity in the face of such aggressive external competition. So naturally, notwithstanding one's own efforts, there will be external environment to contend with. And therefore, the time it takes for the various policy initiatives taken by the government to manifest themselves in terms of rising manufacturing share of GDP may take longer than what it would otherwise be in a relatively not so difficult environment. So it is difficult to give give precise predictions on these aspects.
Dipankar from PTL. Dipankar.
Good evening, sir. Good evening, sir.
Yeah.
Sir, in the last conference, you had predicted that on USD term, we'll be closing FY25 at 3.9 or close to $4 trillion economy, and we are near that. But sir, last week, Niti Aayog CEO had claimed that we have overtaken Japan as fourth largest economy. The numbers released today doesn't seems to match with the claim. What is your response to that, sir?
Yeah, talking about 24-25 numbers today, and
yes, sir.
the dollar GDP was given by the IMF at 0.9. It also matches our. Can someone time, please? Whoever is not.
Dipankar, please switch off your mic because it disturbs when CSR is speaking.
Thank you. So I think for 24-25, the fact that India's nominal GDP is now around 330 point something compared to 331 doesn't change the fact that the dollar GDP value is close to 3.9 trillion was the Niti Aayog CEO said was clarified by a Niti Aayog whole-time member and former CA, Mr. Arvind Virmani, and it is a story for 25-26.
Banikinkar Patnaik, Economic Times.
Sir, good evening. My question is this government final consumption expenditure growth has been muted in the last fiscal, about 2.3%. So probably because of election and other things, as you had explained earlier. But do you expect a rebound in that in this fiscal year to have a positive impact on growth?
No, as I said, we can't give such granular forecast.
Surabhi from Business Today.
Good evening, sir. Sir, I had one small query, sir. We've seen a surge in COVID cases globally and even in India. So, is that a cause of concern? Because in the past, it has impacted contact-intensive sectors like tourism, travel, etc.
No, we don't expect it to evolve into a problem.
Girish Chandra,
Thank you, sir.
Girish, please ask your question.
Hi, sir. Thank you very much for giving us the opportunity. Sir, you had mentioned that conditions are fine for steady, steady growth in coming quarters, sir. But the thing was that the 7.4% growth that we have seen in the fourth quarter last year gives us confidence. But the tariff shock got unveiled in April. So, will a 7+ a percentage growth will be realistic for Q1 this financial year, sir?
We don't make forecasts on a quarterly basis at this point. We don't do that. It's not possible because India's numbers are not seasonally adjusted as well. So it will be unnecessary, and in fact it will be too noisy to give a forecast on a quarterly breakdown of how GDP will evolve. But to say that the trade uncertainty will cast a shadow is not necessarily correct, because as we have been presenting in the past, trade restrictions have been there, and so in some sense we have always said many a time in the past that the 6.5% average expectation, which is what incidentally the International Monetary Fund also has for India in the coming years in real terms, is a recognition of the fact that external sector contribution will be opportunistic, not necessarily something that we can take for granted in the current environment. So that is where we are, and I don't think I can add anything more to that.
Thank you, sir.
Prakash Priyadarshi, ET Now. Prakash Priyadarshi, ET Now.
Hello. Yes, ma'am. Am I audible?
Yeah,
yes,
you are.
So, I have two questions. The first one is with regard to rural demand. With an above normal monsoon forecasting only modest increase in MSP for Kharif crops, do you expect rural demand to grow further in FY26? And secondly, with regard to energy transition program, given India's rising energy demand and cost involved, do you think that the government should consider slowing down the pace of the transition?
I don't have an answer to your second question. On the first question, again, as I said, we don't make granular forecasts for rural, urban demand, etc. We shared with you the data on how tractor sales and vehicle sales are shaping up and how consumption trend in rural India is shaping up. Now, some of you may be aware that NABARD is bringing out a rural economic conditions survey every 2 months. And if you haven't looked it up, you should look it up. It's available in the website of NABARD. And they also
Thank you.
Prakash, please switch off your mic.
And they also predict, NABARD survey also therefore is showing a benign and fairly steady rural demand conditions, etc., with a reasonable amount of optimism. So I think that is where we stand, and I have nothing more to add to that.
Thank you, sir.
Karishma from Business Today.
Thank you, ma'am. Good evening, sir. Thank you for the presentation. Sir, IMF a month back in its APAC review had very specifically outlined the fact that India has a lot of current hurdles when it comes to policy implementation, especially if it's looking to become world's 4th largest or even 3rd largest economy. You have also very strongly spoken.
India has what?
India has hurdles, a lot of hurdles and lags when it comes to policy implementation. You have also very strongly spoken about deregulation. I want to understand what is happening at the back end. A commission was supposed to be formed. What is the update on the deregulation reform of the country?
You would have seen that several states have been making announcements on how they are relaxing building codes, land use regulations, etc. And even yesterday, 2 days ago, Director General of Foreign Trade announced some ease of formalities with respect to leather exports, etc. It is happening, therefore, across different states at different speeds and also in union ministries. And you also saw some announcement in the Business Standard newspaper, if I'm not mistaken, about the union government having told the states to move forward with respect to the implementation of labor code, etc. So these are all the announcements that are out there in the public domain, and we will read about it when the high-level committee on deregulation is constituted.
For the last question now, sir, from Anjal in Indian Express.
So, ma'am, sorry. Sir, it's not yet constituted, right?
You will hear about it if it is constituted. That's what I said.
Okay, thank you, sir.
Anjal, please go ahead and ask your question.
Yeah, hi sir. I just wanted to ask, because you showed in one of the slides the numbers, the comparative numbers with pre-COVID and post-COVID growth rates. So only for the services sector, I believe there was a lower growth rate compared to pre-COVID phase. If you could share your perspective on it, because all other sectors are showing a higher rate.
Yeah, that was just the overall last 5-year growth rate compared to services sector. I mean, obviously, we need to look at, because contact services would have taken a much bigger hit during the COVID years.
Sure.
Fall in air traffic, hotel, tourism, hospitality sectors, etc. So naturally, that is why services sector growth is on the lower side now. So I think you were referring to this. I'm sorry, let me go back and rewind my answer. I basically said this year, the growth performance in several sectors, manufacturing and tertiary sector, agriculture and the secondary sector, have been higher than the average over the last 4 or 5 years. If I go back to that slide, let me take a look at it. Now, I think you are looking at the broad sector-wise growth rates of real gross value added. We said agriculture was 4.6 in FY25 compared to the FY13 to 20 period, pre-COVID period. And the growth rate in industrial sector was 5.9 this year compared to 5.3. And services sector growth this year is 7.2 in FY25 compared to the 8% growth rate of FY13 to FY20. It's very difficult to spell out the causal factors for 0.8%, which is, if you look at it, it is 90% of the last pre-COVID 7-year average. So it's not possible to go into the depths of what really changed in terms of which sector explains this 0.8% deviation from the pre-COVID 7-year average and this year.
Is that all? So with this, anybody else has a question? So with this, we come to the end of the media briefing. I thank you, sir, for all the details and for replying to all the questions. Yes, Sapna, you have a question?
Yeah, a sub-question if you don't mind. Yeah. Okay. Sir, you explained a lot. Thank you, ma'am. Thank you, sir. So you explained a lot in terms of the macro numbers, the micro numbers, but just wanted to get a sense, like, so like, are we looking at the 6 to 7% odd range as the new normal in terms of our economic growth rate? 6 to 7 odd %.
I think
very broadly.
This current. Sorry, go ahead. Sorry, I'll let you complete. Sorry, go ahead.
Sorry, sir. So just wanted to understand that. You explained in great detail. Nevertheless, should we take 6 to 7% range on a very broad basis as a new normal for our economy's growth rate now, in the past, and like maybe 1 or 2 more years, given the global environment?
Look, we have a 6.3 to 6.8% projection for FY26. Now, what happens in FY27, 28, 29? If you want, International Monetary Fund gives you its forecast, not mine. Its forecast for the next few years, and they have taken 6.5% in real terms and roughly around 10% in nominal terms. In this environment, if there is a very swift resolution of global trade uncertainties, etc., and geopolitical conflicts, the normal will be higher. So I think it doesn't make sense to make long-range predictions as to what constitutes new normal, etc. It is a sort of a relatively, if I may dare say, a relatively not so very useful exercise. I think it's important to focus on what is it that we need to do between the private sector, households, and the governments, and the farming sector, etc., in terms of deregulation, in terms of capital formation, in terms of the willingness to upskill oneself, etc. The outcomes will be subject to multiple factors, and those multiple factors have a much higher range of uncertainties than they used to have in the past. So there is no point in speculating on what constitutes a new normal, etc. It's an academic exercise.
Thank you, sir. Thank you very much, sir. Have a great evening, all of you. Yes. Okay. Thank you.
Sir.